Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. In China, the government is cracking down hard on private sector oligarchs, most notably Alibaba's Jack Ma, the Asian Richard Branson. The flamboyant tech billionaire has angered President Xi Jinping by openly criticizing the government. Alibaba has been fined $2.8 billion for what regulators described as anti-competitive behavior, and the eagerly awaited listing of the group's fintech subsidiary Ant has been suspended indefinitely. Alibaba is the world's biggest online marketplace, selling about $1 trillion worth of goods per annum, roughly double Amazon's turnover. As of Thursday night, 145.5 million people have been infected with COVID-19 worldwide, and more than 3.1 million people have succumbed to the disease. The United States remains hardest hit, with over 33 million infections and more than 584,000 deaths. India, Brazil, France, and Russia now make up the rest of the top five, and South Africa is down to 20th position in terms of the most recorded cases. While the Western world seems to have regained a measure of control over the spread of COVID-19, the virus is rampant in India. On Thursday, the South Asian giant recorded 315,000 new infections, the highest one-day tally recorded in any country since the start of the pandemic. This brings India's total number of confirmed cases close to 16 million, second only to the United States' 33 million. As in Brazil under Bolsonaro and the United States under Trump, a lack of decisive leadership is fanning the flames. Prime Minister Modi has resisted imposing a strict lockdown and is himself holding massive election rallies without mask mandates or social distancing measures. On Thursday, 15,000 new deaths were reported worldwide, with about 1 in 5 occurring in Brazil and 1 in 7 in India. The United States is seemingly gaining the upper hand in its war on COVID, and the daily death toll there is now around 700, less than a quarter of what it was when the Biden administration came into office. India is projected to overtake Brazil as the country with the most daily fatalities by the end of April. Other countries experiencing a rise in daily deaths include Colombia, Iran, and Peru. As of Thursday night, 951 million doses of COVID-19 vaccines have been administered worldwide. This infographic shows how many doses each of the top 10 vaccinated countries have administered to date. Some of the more impressive numbers are the United States with 216 million doses, China with 204 million, India with 130 million, and Britain with 44 million. It should, however, be borne in mind that since many of the early vaccines were the double-dose Pfizer and Moderna vaccines, many of the people vaccinated thus far are not, strictly speaking, fully vaccinated. Japan and Canada have announced lockdowns in certain localities after a new COVID variant caused a sudden rise in new infections. The US Federal Reserve this week reiterated that it remains committed to loose monetary policy, even as signs of inflationary pressures are starting to appear. Producer price inflation is rising everywhere from Berlin to Beijing, and food and feed prices keep going up. It is estimated that Brexit has caused outflows of more than £1 trillion British pounds from the City of London, and the European Union has obtained 100 million Pfizer vaccines, enough to vaccinate 20% of its population. Plans for a European Soccer Super League fell through when top French and German clubs refused to participate, and Portugal and Greece will welcome summer vacationers with COVID-19 passports. The Chinese economy is growing at its fastest rate in a decade. Despite some internal and foreign tensions, China's GDP grew by 21% year-on-year in the first quarter in nominal terms and 18% in real terms, that is net of inflation. This must be seen in context though. The growth comes off a super low base as the economy had contracted in the first quarter of last year. The quarter-on-quarter growth number was in fact a rather disappointing 0.6%, lower than the market expectation of 1.4%. Consumer confidence in the United States rose sharply in March and was no doubt boosted by the $1,400 checks households received as part of the Biden stimulus package, coupled to the successful anti-COVID vaccination program. Both the U.S. Conference Board, the gray line, and the University of Michigan, the green line, detected growing optimism in their surveys for March. No other sector of the global economy has suffered more as a consequence of the COVID pandemic than travel and tourism. Between 2019 and 2020, travel and tourism companies' revenue fell by 49%, or $4.4 trillion. Its share of global GDP nearly halved from 10.4% to 5.5%. Over the same period, nearly 62 million people lost their jobs in the sector. Before the pandemic, 1 in 10 jobs in the world were in travel and tourism, and by the end of 2020, this had shrunk to 1 in 11. South Africans should also hope and pray for better days, because here fully 1 in 9 jobs were in this sector before the pandemic. Concern over new COVID outbreaks weighed on stock markets this week, and China was the only major economy where all indices ended the week in the green. US bond yields were steady, but the dollar has continued to soften. This benefited the gold price as well as those of iron ore and palladium, but the oil price retreated as the market contemplated the collapse of demand in India due to the ravages of the second COVID-19 wave. 2021 has been an eventful year on equity markets thus far. To paraphrase Bob Dylan, the times they're a-changing. Last year's leading major index, the S&P 500, is lagging the CAC in Paris and the DAX in Frankfurt. Tokyo's Nikkei and last year's wooden spoonist London's FTSE 100 have performed strongly for the year to date. Hong Kong's Hang Seng is seemingly on the road to recovery, but the Shanghai Composite is still flat for the year to date. The Sensex in Mumbai, the champion over the past decade, has been dragged down by the resurgence of COVID-19 in India. On commodity markets, iron ore and palladium have been the star performers of late. Gold and coal have been the laggards over the past month, while oil's strong upward surge has run out of steam on concerns over sagging Indian demand coupled to rising production. Cobalt, a key ingredient in electric car batteries, had a very strong start to the year, as did lithium, but the prices of both have become becalmed of late. The electric vehicle metals index has benefited from rising interest in and demand for electric vehicles in recent times. It reached its highest level ever in December, and despite slipping somewhat since, February was its 4th best month ever. The index is a composite of the prices for lithium, the blue bar, graphite, the orange bar, cobalt, the purple bar, and nickel, the green bar. Although the prices of some of these commodities have softened of late, there is no doubt that the growing global commitment to a greener economy will support prices going forward. The IMF believes that global GDP growth this year will be the strongest in decades, with next year less so but still robust. The pandemic seems to have left few long-term scars on the global economy, and it is too soon to tell whether the current recovery is sustainable over the long term or merely a reaction to massive stimulus. Although inflationary pressures are building everywhere, these should recede as supply chains normalize. Average developed market inflation over the next few years will, however, be a bit higher than in previous decades, but runaway inflation is unlikely. Given the extent of inflationary pressures, central banks will probably have to start hiking interest rates sooner than they're currently saying, but later than what the market is pricing in. Even if inflation is persistent, there is a limit to how high bond yields will rise in a world with excess savings looking for a low-risk home. We must, however, point out that the post-pandemic re-rating of equity markets is behind us and that future returns will have to be the result of earnings growth. The environment remains positive for risk assets, but we believe that different markets will come to the fore and that different sectors might outperform going forward. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are locally. The week's biggest and saddest news was the massive wildfire that ravaged Devil's Peak and parts of Table Mountain in Cape Town. Although arson cannot be proved at this stage, a vagrant has been arrested in connection with the fire. Damage estimated at well over R1 billion was caused, including most of the UCT library, residences, private homes, and the historic Mosterd's windmill, which dates back to the 18th century. On Thursday, South Africa suffered 55 new COVID-19 deaths, bringing the total death toll thus far to just under 54,000. Nearly 1.6 million South Africans have now tested positive for the virus, and sadly the vaccination program is still on hold, with only 293,000 people having been vaccinated. On Thursday, Cabinet decided to lift the suspension, however, noting that no South Africans have thus far had blood clots as a consequence of receiving the Johnson & Johnson vaccine. The rollout to non-health workers over the age of 60 is due to start on the 17th of May. Consumer price inflation moved back to within the Reserve Bank's target band of 3 to 6% in February, due mostly to higher fuel costs, as core inflation actually edged down. The Reserve Bank expects inflation to rise further, so interest rate cuts are now unlikely. Given the weak state of the domestic economy, it is, however, equally unlikely that interest rates will be hiked anytime soon. The leading indicator and retail sales rose in February, and COSATU wants to strike over public sector wages. The President envisages upgrading the Port of Durban through a public-private partnership, and the New World Wealth Survey found that 4,500 ultra-high net worth individuals have left South Africa for greener pastures over the past decade. The COVID-19 pandemic has caused immense hardship on many levels. One of its many legacies is the increase in poverty. Since the start of the nationwide lockdown just over a year ago, South Africa's GDP per capita has fallen from 54,000 rand to 49,000 rand, a drop of over 9%. This wiped out all progress in poverty reduction since 2005 and will no doubt exacerbate our country's myriad socio-economic problems. In a previous presentation, I mentioned that the actual cost of obtaining fuel represented barely a third of the pump price. This infographic depicts how the retail price of 95 octane petrol is made up. 35% of the price, the blue bars, consists of the basic fuel price. 26%, the green bars, consists of customs and excise taxes. 14%, the grey bars, goes to the Road Accident Fund, and 25%, the red bar, consists of the fuel levy. Over the past 12 years, the portion of the price paying for the fuel itself has dropped from 60% to 35%, and the portion consumed by taxes and levies has risen from 40% to 65%. The COVID-19 pandemic has seen the trend towards online shopping in South Africa accelerate. It is estimated that 3.3 million more South Africans will be shopping online this year than before the pandemic, an increase of more than 15%. The number of online shoppers represents two-thirds of the country's adult population, which is surprisingly high when one considers how many people live in absolute poverty and don't have the means to transact online. Along with most other equity markets, the JSE spent the week on the back foot, with all three macro sectors down. The bond market was strong though, and the rand rallied against the US dollar, even as it weakened somewhat against the euro and pound. Oracle has upped the ante in its spat with Eskom, and FNB has decided to cut its losses after 12 years of trying to establish its brand in India. Meanwhile, Absa's first black CEO is leaving over what the company's board described as irreconcilable differences over strategy. The JSE is not only one of the world's best performing equity markets for the year to date, it also offers among the most attractive valuations, despite the all-share index's impressive re-rating. The S&P 500's average price-to-earnings ratio, the orange line, is currently just over 22 times. The MSCI World Index ex-United States, the brown line, is at 16 times, and the MSCI Emerging Market Index, the grey line, at 14 times. The MSCI South Africa Index, the blue line, is currently trading at a modest 11 times. There were net foreign inflows into both the local equity and bond markets last week. 230 million rand flowed into the JSE and 1.27 billion rand into the bond exchange. For the year to date, however, both markets have suffered net foreign selling. The JSE has lost 8.15 billion rand and the bond exchange just under 30 billion rand. The rand continues to hold its own on foreign exchange markets. This week, the local currency, depicted in dark blue, was the best performer amongst its emerging market peers, closely followed by the Mexican peso, the purple line. Since the start of the COVID pandemic, the rand, the peso, and Indonesian rupiah, the grey line, have consistently outperformed other emerging market currencies relative to the dollar. The rand started off April at 14 rand 91 to the dollar and has since firmed to below 14 rand 30 to the greenback. This infographic depicts how the main asset classes have performed in recent years measured in rand. After almost habitually being the best performing asset class over the past 15 years, foreign equity, in purple, is lagging SA equity, in orange, and SA listed property, in dark green, for the year to date. After a strong 2019 and 2020, South African bonds are currently at the bottom of the year-to-date rankings. It is pleasing to note that risk assets have been outperforming inflation, in blue, over the past 2 years. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.